All right, in this lesson, we're going to go over dividends specifically for preferred shareholders. So we're going to show you the calculations and we'll talk a little bit about the journal entries associated with these types of dividends. So to kind of give us started off here, the preferred dividends are very similar to common stockholder dividends. However, there are two dividends two ways dividends are issued. The first one is current, and the second one is cumulative. So we're going to focus on the current first, and then we'll talk about the cumulative on the back end of this lesson. So let's start here with the current. So when we talk about current dividends, so a current dividend preference means that current dividends are paid to preferred shareholders first. So we take a look at how much dividends have been issued, and then from there, we say, okay, how much of this goes to preferred shareholders versus how much goes to common shareholders based on what the preferred shareholder policy is. Now, once those are paid, then any remaining dividends can be paid to the common shareholders. Now, we haven't talked about cumulative. We will in a minute here, but when we think about current, we mean we're only looking at this year's numbers. So we don't care what happened in the past. We're just looking at this year's numbers and what preferred shareholders should be getting based on this year's numbers. So kind of an example here to walk us through here. Company A has the following shares outstanding. They've got a 5% par 30 preferred share. They've got 5,000 of those. And then they have common shares of $100,000. Now, the company's board of directors has approved a $10,000 dividend to be paid to their preferred and common shareholders. Calculate the dividends paid to preferred versus common. So the first thing that we have to know is that preferred shareholders get their money first. So we need to calculate how much they get first, and then whatever remaining amount we can then distribute to our common shareholders. So to calculate this first, we need to calculate how much dividends do they get? And to do that, we're going to figure out what's the basis for us calculating their 5%. And the way that we calculate this is we're going to take the number of shares outstanding for preferred, which is 5,000, and we're going to multiply it by its preferred shares par value. So in this case, the par value is $30. So if we do 5,000 times 30, we get $150,000. Then from there, we're going to multiply it by that percentage that they get as a preferred shareholder. So in this case, it's 5%. So we'll multiply that by 0.05 and we get $7,500. So that $7,500 represents how much preferred shareholders get of the dividend distribution. So in this case, $7,500. So based on that, we can calculate how much common shareholders get to share in. And so we know that the board has approved $10,000 of dividends. We'll subtract $7,500. So common shareholders will get $2,500. So of the $10,000, preferred shareholders get their 5%, which is $7,500. And then the rest, $2,500, gets to be split amongst all the common shareholders. So there is definitely an incentive to holding a preferred stock in this point, because you're getting more as a cumulative body than you are the common shareholders, right? So that's our split there. Now we got to do the journal entry associated with that. So we've got our journal entry, we've got the calculations above. So what do we know? Well, we know that this is going to have to be paid to common stock and preferred stock. So when the dividends are declared, we are going to debit dividends just like we normally would. So we'll debit dividends, and this is in the amount of $10,000. And then what else do we have? Well, we have a liability. So we are going to credit dividends payable for their separate amounts. Now we're going to break it upon the amount that goes to preferred and the amount that goes to common. So we're going to credit dividends payable, and this is going to be for preferred, and they're getting $7,500. So we're going to book a liability for the amount that we owe them. Then we have our dividends payable, and this is for common, And for common, it's going to be $2,500. So that's establishing our liability on the date of declaration. The only other entry that we have later on would be the payment. And the payment is very similar like the common shareholders that we talked about in the prior lesson. We'll just debit the payables and credit the cash that is being given to our stockholders. So that is what we would do for our preferred stock dividends for our current preferred stock dividends. Now, the other preference that we have is something called cumulative dividend. So what does that mean? Well, a cumulative dividend preference means that any dividend that was not paid in full based on the percentage and par value, like for the last example, 7,500, will be accumulated to future periods and must be paid first before the common shareholders are paid. This is called dividends in arrears. So let's kind of think about what this means. So let's say last year we paid $5,000, which means we should have paid them $7,500, but we only paid them $5,000. So there's $2,500 that wasn't paid to them. That becomes a dividend in arrears, which means in the following year, before any dividends can be paid to common shareholders, not only do we have to pay this year's $7,500, but we also have to make up for any dividends in arrear. If there was dividends in arrear, which there was $2,500, we'll tack that on. So before common shareholders get anything, preferred shareholders need to get $10,000, $7,500 from current and $2,500 from cumulative dividends in arrears. Now, as we talk about that, and before we get into any example here, it's important to know that not all preferred stock holds a cumulative dividend preference. So there may be a preferred stock that does not hold a cumulative dividend preference, meaning that if they only got $5,000 last year, that $2,500 can't be carried over to the following year. So it's important to know, does the preferred stock have a current dividend preference, meaning we don't even count prior dividends in arrears, or does it have a cumulative effect? If it has a cumulative preference, it means that any dividends that we haven't paid in the past need to be made up for before the common shareholders get their dividends, okay? So let's take a look at an example that has to do with a cumulative dividend preference. So company A has the following shares outstanding. Notice that we've kind of had the same thing, but the only difference here is that there's a $5,000 in dividends in arrears, which means that the preferred shareholders didn't get $5,000 of their dividends in a prior year. So we're going to have to make it up here in this year because the board of directors has approved $20,000 in dividends. So we're going to need to see how much of that $20,000 goes to preferred shareholders versus how much goes to common shareholders. So to start us off, we got to calculate how much preferred shareholders get. So in this case, we're going to do the same calculation here. We're going to take the number of shares, in this case 5,000, and we're going to multiply it by its par value of $30. That's going to give us $150,000. And then we're going to multiply it by 5%, which would give us this year's dividends for preferred shareholders of $7,500. Now, we're going to add on to that any dividends in arrears. Well, we have $5,000 in dividends in arrears. So we're going to add that. That gives us a total amount of dividends that we need to pay to our preferred shareholders of $12,500. So once we have that, then we can calculate how much can go to common shareholders. In this case, the board has decided to issue $20,000 of dividends. So we'll subtract $12,500 and common shareholders will get $7,500 of the $20,000. So preferred gets $12,500, common gets $7,500. So if we look at, well, we didn't do the journal entries. I thought we would do the journal entries, but the journal entries would be the same as the last one, which is probably why we're not doing them here. So that would be our split. The journal entries rewind about 3 minutes here, and you would see the journal entry. Same thing, just different numbers. So that's what we would do in a cumulative situation. Again, it's important to read a question if you get this of what is this, a current only or is this a cumulative? It's cumulative, then we need to tack that onto the current, and that is what will need to be paid. The only difference here is if this problem said that the board of directors has approved $10,000 of dividends, then we would say, okay, we owe $12,500 to preferred, so we're going to pay them their $10,000. Now they have $2,500 in arrears, and common shareholders this year get nothing. So do know that that's what happens in this case. And so until the preferred shareholders are gone, meaning that the company has bought all the preferred shares, this is going to continue happening, especially for a cumulative dividends preference for the preferred shareholders. If it's just current, then it's not a huge problem because anything that wasn't paid doesn't get paid to them in the future. So hope you enjoyed this lesson on preferred stock dividends, and we'll see you in the next lesson. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.